Friends, now let's do a problem on sales mix variance and sales quantity variance. Okay, so as I already told you in the previous session, sales mix variance and quantity variance will come only when an entity is dealing in multiple products. When there is only one product, it is a single product entity, then there won't be any which variance? Sales mix variance. Okay, so sales mix variance will come only when the entity is dealing in more than one products or multi products. So you can write a note on that. Note an entity will have sales mix variance only if it is dealing in multiple products. Okay, and tell me, what is the major cause for the sales mix variance? Sales mix variance occurs when the actual composition of the products is different from the budgeted composition. Say for example, as per the budget, a company should sell 3 products, that is A, B and C, in the standard proportion of 1:1.5:0.5. Okay, 1:1.5:0.5. That means when 3 goods are sold, 1 good should be product A, 1.5 goods are should be B, and 0.5 goods should be C. That is the standard proportion. However, okay, the actual production and sales were, let us say, 8,000 units of A, 12,000 units of B and 10,000 units of C. Okay, now this is the standard proportion. The standard proportion is 1:1.5:0.5, whereas actual number of units sold was 8,000 units of A, 12,000 units of B and 10,000 units of C. Can you tell me why does the mix occurs? Okay, now here what you can see is total number of units sold is equal to 8,000 plus 12,000 plus 10,000, which is equal to 30,000 units. So based on the standard, the number of units of A, B, and C sold should have been what would be the formula? A is equal to 30,000 into, okay, 30,000 is the total number of units. Now what is the proportion? The proportion is 1 plus 1.5 plus 0.5 will be 3. So 1 divided by 1. 1 divided by 3, 10,000 units, and B, the standard proportion is 1.5 out of 3, so this should have been 15,000 units, and in the case of C, it should have been 30,000 0.5 divided by 3, that is 5,000 units. Okay, so the standard proportion was 1:1.5 is to 0.5. Going by the standard proportion, the company ought to have sold 10,000 units of A, 15,000 units of B, and 5,000 units of C. Okay, this is the standard proportion. Okay, now what is the actual sales? Actual sales was how many units of A sold? 8,000 units. Okay, and what about B? 12,000. And what about C? C, we sold 10,000 units. Okay, total 30. See, there is a change in the required proportion or the required composition of the goods and actual composition of the goods, and this change or variance in the proportion will lead to what? Mix variance. So here 2000 units negative, here 3000 units negative, and here 5000 units positive. Okay, so this will be adverse, this will be adverse, this will be favorable. Is it clear? And this variance is translated into which variance? Sales mix variance. Okay, right. Now let's do one problem in page number 12.29. You can take the question. Page number 12.29, there is an illustration. You can pause the video and read the question once. Okay. Okay, I think you have read the question. Now let's see what is given in the question. Queensland Chemicals manufactures high quality chemicals C1, C2 and C3. Okay, so there is a company called QC, Queensland Chemicals, or QC. It is selling how many units, producing and selling how many products? 3 products, C1, C2 and C3. So it is a multi-product situation. So there is a possibility of what? Sales mix variance. So you can write that since there are 3 products, there could be sales mix variance. Sales mix variance. Is it clear? Okay. Now what is the information given? You have the extracts from the budget for the last year are given. Budgeted data is available. Sales quantity details are there. Average selling price per kg. Then direct material cost that is given. Then direct labor cost is given. Variable overhead cost is given as per the budget for each of these 3 products. Now budgeted labor, direct labor cost per hour was how much? 160. Okay, labor rate. This is labor rate budget or standard rate or SR. Now actual results for the last year were as funded. Sales quantity different. Then selling price, direct material cost, direct labor cost, variable overhead cost. Everything is given. Now actual direct labor cost for hour was rupees 150. Actual variable overhead cost per direct labor was rupees 20. QC follows just-in-time system for purchasing and production and does not hold any inventory. Okay, what is the requirement? The requirement is to interpret sales mix variance and sales quantity variance in terms of the contribution. Okay, so you will have to compute sales mix variance and sales quantity variance from the given problem, and then you interpret that details. Okay, now how to do that? First of all, you have to see, is there any difference between the budgeted production and actual production? Okay, or budgeted sales and actual sales. Okay, so total budgeted sales It is not budgeted production, it is budgeted sales, because we are concerned about revenue. So it should be sales. What is the budgeted sales? 1000, 3250 and 750. So 1000 plus 3250 plus 750. It comes to 5000. Okay. So budgeted sales is 5000 units. And is there any standard proportion? Standard proportion of what? C1 is to C2 is to C3. Okay. What is the standard proportion? The standard proportion is 1000 is to 3250 is to 750. 1000 is to 3250 is to 750. Okay, I am writing that proportion. Now, what is the actual number of units sold? Actual number of units sold. What should be the actual number? What is the actual number of units sold? We have sold A, how many units? 900. And B, how many units were sold? 3875. And C, how many units we sold? 975. So what is the total? 900 plus 3875 plus 975. It comes to 5750. 5750 units. See, our budget was only to sell how many units? 5000 units. But how many units actually you sold? 5750 units. Okay. Now, when you sell additional 750 units or 5750 units in total, this should be in which proportion? It should have been in standard proportion. If it was in standard proportion, then there won't be any mixed variance. Is it clear? So here what you have to do is you have to check whether the actual sales was in the standard proportion itself. Okay. So how to do that? First, you have to do some working notes. Okay. So how to do the working note? You need to find out the standard contribution first. Okay. So you can give the working note number 1, statement of standard contribution. Why standard contribution is required? Because that is required for computing the mixed variance. Okay. So C1, C2, C3. Unit is rupees per kg of C1, C2, C3. Okay. You can start with average selling price per unit. What is the average selling price per unit? See, this is standard contribution. So you should do it based on budgeted data. It should be based on budgeted data. Okay. So what is the information? 17600, 2560, 22400. 17600. Then 2560, 22400. Now less. Direct material. Material cost how much? 8000, 1280, then 9600. 8000, 1280, then 9600. Then less. Direct labor cost. Direct labor cost. If you see 3200, 480, 4800. 3200, 480 and 4800. Okay. Then variable overhead. Variable overhead cost. What is the amount? It is 320, 48, 480. 480. So you get what? Contribution per kg or contribution per unit? Contribution per unit. 17600 minus 8000 minus 3200 minus 320. That will give you 60 80, 2560 minus 1280 minus 480 minus 48, 752. 22,400 minus 9,600 minus 4,800 minus then 480. This comes to 7520. That is the contribution per unit. Okay. Now what do you have to do? Now you need three things actually. Okay. One is budgeted quantity, that is BQ. Then you get budgeted proportion, then actual quantity, that is AQ, then AQ in budgeted proportion. RBQ, revised budget quantity, or AQ in budgeted proportion. Okay, that is what we are going to see here. Okay, now you can write statement of sales contribution mix variance. So this is mix variance. Okay, how do you do this? First is products, then AQ salt, actual quantity salt, then AQ, or let me write it as budgeted proportion. Okay, then AQ in budgeted proportion. Okay, then you have difference, then standard contribution per unit, then you have mix variance. Okay, this is 1 2 3 4 5 is 2 minus 4, then this is 5, this is 6, 5 into 6. Okay, fine. Now what next? Product C1, AQ is 900, then C2 we have 3875, then C3 is 975. So what is total? 5750. What is budgeted proportion? Budgeted proportion is the proportion as per the budget. Okay, so as per the budget it was 1000 out of 5000, then 3250 out of 5000, then 750 out of 5000. Now AQ in budgeted proportion, that is 5750 into 1000 divided by, that will be 5750 into 1000 divided by 5000. It is 1150. Okay, then next 5750 into 3250 divided by 5000. 5750 into 3250 divided by 5000, that will be 3738. Next 5750 into 750 divided by 5000, that is equal to 5750 into 750 divided by 5000. 862. Total again 5750. So what we are doing here, this is the total actual quantity. This is restated in standard proportion. Okay, you sell more units. Your budget was only 5000, but you sell 7750. Okay, agreed. But that increase, or this entire 5750 units sold, that should be in the proportion which is as per the budget. Okay, that is the requirement. Now what is the difference? How do you compute the difference? 900 minus 1150. Okay, so actually you ought to have sold 1150, but how many you sold? You sold only 900, so there is a difference of 250. Okay, which is an adverse variance. Why adverse? Because you should have sold 11150, but you sold only 900. Okay, next is 3738 minus 3875. Okay, it is 137. Is it favorable? 137. Yes, it is favorable. Why favorable? You should have sold only 3738, but you sold 3875. More you sold. Next, 862 minus 975 will be 113. This is also favorable because actual quantity sold is more than this one. And what is the standard contribution per unit? Standard contribution per unit you have computed 6080, 6080, 752 and 7520. So 250 into 6080 will give you 15,20,000. And what is it? This is adverse. Next is 752 into 137, 103024. This is favorable. Next is 7520 into 113. That is 8,49,760 favorable. So 103024, 103024 plus 849,760, 849,760 minus 15,20,000. So 567,216 adverse net. Okay. So net sales contribution mix variance is rupees 567,216 adverse. Clear? Okay. Now what next? You have to find out sales contribution quantity variance. This is mix variance. Now quantity variance. Sales contribution quantity variance. Okay. Now how do you compute this sales contribution quantity variance? It is the variance due to difference in budgeted quantity and actual quantity in budgeted proportion. Okay, how do you compute this? So budgeted quantity is BQ versus RBQ. Okay, now statement of sales contribution sales contribution quantity variance. Products, then you have budgeted quantity or BQ, then RBQ, then difference, then standard contribution, then quantity variance. C1, what is the budgeted quantity? It is 1000. Actual quantity in budgeted proportion 1150. C2 is 3250. Then 37 or 38. What is RBQ? 3738. Okay. Then C3 750 and 862. Difference 150. BQ and RBQ is more, so this is favorable. Okay, 3250 BQ 3738. So what happens? 488 favorable. 750 became 862. That is 112 favorable. Standard contribution is 6080 here. Then 752 here. 7520. 150 into 6080 will give you 9,12,000. Then 488 into 752 will give you 3,66,976. 112 into 7520 will give you 842,240. So this is also favorable, this is favorable, this is favorable. 912,000 plus 366,976 plus 842,240. Total will be 21,21,216. Thus, total sales contribution is it clear? Yes. Okay, so we have computed both sales contribution, mix variance and quantity variance. Now what about next? Interpretation. Okay, if you see the interpretation, what is happening here? In the first case, that is, we will take sales contribution quantity variance. It is 21,21,216 favorable. Can you tell me why it has become a favorable variance? If you see the components, the product wise components, it is a favorable variance for all the three products, C1, C2, C3, it is favorable. Okay, and why is it so? It is so because this quantity variance is the difference between what? The actual quantity and the budgeted quantity. Am I right? Actual quantity means how much? It is 1150 plus 3738 plus 862, 5750. Here it is 5000. So you budgeted only 5000 units production, but you actually produced 5750 units. Okay, so all the three products, your production should increase ideally. Why it has not reduced? If you see the actual sales, sometimes it may be even lower than these figures. That is okay, because that is the change in mix which we have considered in the next variance. But as far as quantity is concerned, when the overall quantity increases, it will lead to a favorable variance. Okay, so interpretation of variance, you can say first quantity variance, the total budgeted sales quantity was only 5,000 units. However, the entity actually sold how many units? 5,750 units. Okay, which is 750 units more than the budget. More than the budget. This is a favorable variance resulting in additional sales contribution. Hence, it is a favorable variance of 21,21,216 F. Next, what? Sales contribution mix variance. Sales contribution mix variance. What you can write? As per the budget. As per the budget, the standard proportion of sales of A, B and C is, what is the standard proportion? The standard proportion should be 1000 units is equal to 3250 is equal to 750. Therefore, when the company sold 5,750 units, it should have been in the above proportion itself. However, the actual sales mix of A is to B is to C is different, which has led to sales contribution mix variance. Sales contribution mix variance. Okay, now if you see the mix variance, it has resulted a net adverse variance of 567,216. Now you have to see why it is an adverse variance. If you see clearly, in the case of C1, actual quantity that ought to have sold is 1150, whereas it has actually sold only 900 units, and the contribution is highest for C1 and C3. In case of C1, it is a favorable thing. 862 you should have sold, but 975 you have actually sold, so it has resulted in a favorable variance. But the adverse fall in the number of units sold in case of C1 and the consequent loss in the contribution on account of that fall in the sale units of A is much higher than the combined increase or additional contribution in case of C2 and C3. Okay, so you can write just led to sales contribution. Now you can write the total sales mix variance is how much? Rupees 5,67,216 adverse. 5,67,216 adverse. It is because in case of C1 the actual sales ought to have been 1150 units as against what? 900 units. Currently sold. This fall in sales quantity, that is 250 units, have resulted in a loss of contribution of rupees 250 into 6080 rupees 15,20,000. Okay, in case of C2 and C3 the actual sales quantity is higher than that of the quantity that ought to have sold, this will result in additional contribution. However, the additional contribution given by C2 and C3 together, C2 and C3 together was less than the loss of contribution in case of C1. Hence, it resulted in an adverse net sales mix variance. Is it clear? Okay, so that is the inference you can see. And even then what you can find is, if you see the sales mix variance, the difference is 250 adverse in case of C1, and what is the contribution here? 6080. Now this 250 adverse is offset by 130 favorable in case of C3 and 137 favorable in case of C2. But the problem is, in case of C2 the contribution per unit is just 752. So what has happened is, the actual sales of C1 went down whereas that of C2 went up, but by the the loss of contribution in case of C1 was around about 15 lakhs 20,000, whereas the additional contribution received in C2, which is a lower contribution yielding product, is only 1,03,024. So by less producing, by the shortfall in sales of C1 was offset by the additional sales in C2, but C1 is a high contribution yielding product, whereas C2 is a low contribution yielding product, and the additional contribution from C2 was not able to recoup or adjust the loss of contribution in C1, due to which it resulted in a net negative variance or adverse variance. Okay, so that is what actually happened. Okay, so that is all with this particular problem. Now you have to move to the next problem. There is a case study given after this problem. You can take page number 12.31 case scenario. 12.31 case scenario. Page. You can pause the video and read the question once. Okay, so what is given in the question? Natural spices manufactures and distributes high quality spices to government food shops and top quality restaurants. Government and high-end restaurants pride themselves on using the freshest, highest quality ingredients. So there is a company, and what is the name of this company? The name of this company is, which is that, Natural Spices. Natural Spices. And what does this Natural Spices do? Natural Spices manufactures and distributes high quality spices. Manufacture and distribution of high quality spices. Okay, high quality spices. Okay, now going forward, government and high-end restaurants pride themselves on using the freshest, highest quality ingredients. Yes. So what does it mean? It means that this company is well known for its quality, and people or consumers consider it as a pride to use this products. Okay, very important. Now going forward, Natural Spices has set up 5 state-of-the-art plants for meeting the ever-growing demand. The firm procures raw material directly from the centers of produce to maintain uniform taste and quality. So there are a lot of parameters that the company is set up for ensuring the quality. The raw material is first cleaned, dried and tested with the help of special machines. Then it carefully grounded into the finished product, passing through various stages and packed at the firm's ultra clean factory before being dispatched to the customers. So everything, each and every process of this company is oriented towards what? Ensuring the quality, superior quality. And that is the name of this company. This company is known in the market for its quality. Okay, now the following variances pertain to last week of operations arose as a consequence of management decision to lower prices to increase volume. So what is the management decided? Management decided to lower prices to increase the volume. Okay, it reduced the prices of these products. So what is the impact? It can sell more. Okay, and the result of this decision was given. Sales volume variance 18,000 favorable, sales price variance 14,000 adverse, purchase price variance 10,000 favorable, Then labor efficiency variance 11,200 favorable, and fixed cost expenditure variance 4,400. Now what is the requirement? Identify the critical success factors for natural spices. Evaluate the management decision with overall corporate strategy and critical success factors. Very easy question, nothing difficult in this. Okay, but you need to think a lot. Okay, now first question is what? Critical success factors for natural spices. Critical success factors for natural spices. What is the CSF or critical success factor? Factor. You don't have to think too much for this. What is the CSF? It is nothing but highest quality. Okay, highest quality. So you can write from the given scenario. It is very evident that natural spices is known in the market for its superior quality products. Okay, so what you can write? Though there are many other factors important to the success of the entity, such as what could be the other factors which the company needs to which the company needs to think, okay, as to bring success to its products, such as what? One, lower price, affordable rates, affordable prices, then delivery options, then packing, etc., such as affordable prices, delivery options, packing, etc., comma, the quality of the products could be deemed to be, could be taken as the critical success factor contributing to the success of the entity. Okay, so the critical factor is what? Quality. Okay, right. That is one problem. Okay, so critical success factors we have identified. Now, okay, what is the second question? Evaluate the management decisions with the overall corporate strategy and critical success factors. What was the management decision? Management decision was what? Management decision was to lower the price to increase the volume. That was the strategy. Okay, now what is the impact of the strategy? As evident from the variances. Okay, now how can you evaluate this strategy? See, what has happened to sales volume variance? Sales volume variance have increased. It's a favorable 18,000. And what about sales price variance? It is 14,000 adverse. Okay, so there is a favorable variance on account of sales volume, whereas there is an adverse variance on account of selling price. What does it indicate? It indicates that the selling price has reduced from the budget selling price. Okay, that means they have consciously reduced the selling price, whereas the volume has gone up. That is why you are getting a favorable variance. And what is the net impact? Net impact is 18,000 favorable and 14,000 adverse, so which gives you 4,000 favorable. So on a net impact, the price has, or the profit has gone up by the strategy. Okay, it's given that sales volume variance is 18,000 favorable, and sales price variance $14,000 adverse. What is the net impact? Net impact is rupees 4,000 favorable. Okay, so what you can conclude here? The conclusion is the strategy to reduce the selling price has resulted in an adverse variance, adverse sales price variance. Okay, on the other hand, the sales volume variance shows 18,000 favorable, indicating increase in volume on account of reduction in selling price. On an overall basis, what is the impact? 4,000 rupees favorable. So you can write on a net basis, the strategy has helped the entity to increase the profit by rupees 4,000 favorable. Okay, therefore, what could be your conclusion? Therefore, to such extent, the management strategy has helped to increase the profit increase the profit. This is one observation. But is there any problem with this strategy? Yes. What is it? The company is known for its quality. So by reducing the selling price, the company is able to make it a more affordable product. Okay. Now there are some premium customers or premium restaurants or government's products who take themselves as a pride of owning or using this particular company's products. Okay. Now by reducing the selling price, more and more consumers will try to start using this so that its premium class will go. Okay. So that is something against the USP, the current USP of this particular product. Okay. So currently, so you can write, however, currently the company's products are deemed as premium products and government foods and high class restaurants pride themselves on using the products of this company. Okay. By reducing the selling price, the company may lose this unique selling proposition, USP, unique selling proposition. This is one issue. Now similarly, if you see what is the next variance, the next variance is purchase price variance. It is 10,000 favorable. Okay, you can write purchase price variance is 10,000 favorable. What does it mean? The meaning is that the purchase price of the raw materials or spices was lower than the budgeted price. While it will increase the budgeted profits, there is a harm for this. When the purchase price reduces, there is a chance that the quality may be compromised, which is against the overall objective of the company. Okay. So though the purchase price variance is favorable to the entity, it has resulted in lower purchase price as compared to the budgeted purchase price. This may affect the quality of the products. Procured. Okay, that is another issue. Now which is the next one? Labor efficiency variance 11,200 favorable. Again, this is a favorable variance. Labor efficiency variance 11,200. Okay, rupees 11,200 favorable. Now what is this labor efficiency variance? Labor efficiency variance depicts or it denotes the efficiency of laborers. And how do you measure the efficiency of laborers? It is the number of units produced per hour. So when you say that the labor efficiency has increased, it means that the number of units produced per hour by the laborers have gone up. Okay, so number of units produced per hour has increased. Now while it may look like a favorable aspect, there is a negative to it. When the production per hour increases, there may be a compromise on the quality. Okay, so though increase in labor efficiency will increase the profitability, the entity should check if there is any impact on the quality of the products. Okay, that is for labor efficiency variance. Now there is fixed cost expenditure variance. What does it mean? 4,400 favorable. 4,400 favorable. Okay, which means, what does it indicate? Actual fixed overhead was less than budgeted FOH. Okay, now why it is less? This may be due to any decision affecting the quality or features of the products. Okay, hence the entity should reconsider such decisions. Okay, so even though the except for the sales price variance, all other variances are favorable, the company will have to see whether these favorable variances are on account of certain aspects which is affecting their the unique selling propositions. Okay, or is it affecting the quality of the products? If yes, it has to reconsider. Otherwise, it is okay. Is it clear? So that is how you evaluate the management decision. Okay, right.